Welcome back. We've been talking about risk, and the conversation I thought was very insightful. It's something that you can definitely use if you're a prospective investor. Simply put every goal that you have, and this is a very basic approach to have, of course, through the metric that was suggested by Kiran, which was to understand your risk tolerance level, your risk-taking capability, and finally the risk that you would need to take in order to achieve that financial goal. Now, let's also talk about the RiskOMeter. Kiran, this is something I think that is a very useful tool to have, and it's a great change that the regulator brought. Would you be able to give us a little bit of context and to help us understand what the RiskOMeter does and what it achieves?
Yes, so the RiskOMeter, if we talk from those 3 points which we were earlier discussing, so this comes to the product level risk identification capability. So the regulator SEBI has mandated that all mutual funds, put their schemes through this RiskOMeter. So there is a very detailed manner in which each scheme has to be judged on the parameters given by SEBI. And basis that, they have been categorized into 6 risk levels, starting from low to very high. So this is for all kinds of schemes, right from your debt schemes to equity and hybrid and gold schemes also. So each of these schemes will have a certain level of risk which will be shown upfront to the investor when they are deciding to invest. And this needs to be updated by the AMC every month. So if there is a change in the risk level of the scheme, it has to be, communicated to the investor who has already invested. Likewise, at the end of the year, the AMC will have to basically tell that how many times the risk levels have been changing in the scheme. So how many levels have moved through the year. So this becomes a very, it's a good starting point for any investor to figure out whether that scheme is suitable for his or her requirements. Say, for example, when we talk about equity schemes, now how this RiskOMeter works for equity schemes is that there are 3 parameters on which the risk is being judged. The first is the market capitalization, second is the volatility, and third is the impact cost. So this broadly covers the major kind of risks that any equity scheme can have. Let me give you a small example. So if you're talking about a large cap scheme vis-a-vis a small cap scheme, so the market capitalization of a large cap scheme is obviously much higher than that of a small cap scheme. So that way the risk of the large cap scheme will be lower than that of a small cap. Likewise, volatility will differ between different schemes. And what they mean by impact cost is that if there is a particular scrip holding within that mutual fund scheme, which is an illiquid stock, so what will be the impact on the scheme if there is a large purchase or sell order in that particular scrip? So if it is the impact cost is very high, the scheme becomes riskier. So that means it is covering the problem of illiquidity of stocks within a scheme. So I think this is a very nice way to, present the broad level risk of the scheme that is being available. Though I would say that there are still certain risks which are not covered. But so far, this has been a very detailed, RiskOMeter which has come up. Likewise, in debt schemes, there are 3 essential parameters which are being covered. The first being the credit risk. The second is the interest rate risk, and third is the liquidity risk. So on all these 3 very critical parameters for any debt scheme, you get the RiskOMeter at various levels. So within a category also, say for example, there could be a short-term debt scheme. So within that category, there could be different schemes which are at different risk levels. So you can choose something that suits your risk capacity more.
I want to ask you a few more questions about individual equity and debt schemes and the risk associated with them. But allow me to take one more break before we do, Kiran. I'll come back with a few more questions. Viewers, do stay tuned. This is an interesting conversation, and I'm sure that you're going to be learning a lot more on the other side of this break as well. Welcome back. You're watching The Money Show. We've spoken about various aspects of risk, and we were specifically talking about the RiskOMeter, which is a tool that allows you to understand the risk associated with mutual fund schemes. This is something that was introduced not too long back. I want to focus a little bit more on equity. Taking from the question that my viewer in The Morning Show asked, is this safe? I think this is very important to understand when we're talking about the RiskOMeter. In your assessment or in your experience, most of the equity schemes, at what end of the RiskOMeter would they fall under?
Equity schemes, I mean, as an asset class, equity is volatile. So the volatility of all equity schemes will be pretty high. So that will have a huge impact on the scores. So most equity schemes will fall on the high or the very high end of the spectrum in this RiskOMeter. Because per se the asset class is pretty risky. Now within that, there could be differentiation between large cap or small cap. So I am not very sure if the RiskOMeter is actually covering that because it's still pretty new. So there are some more, I think there is some fine tuning required in that aspect to really differentiate between, say, an index fund, which could be a little less risky as compared to a small cap fund. So that way, I think there is still a little bit of tweaking required, but it's a great beginning to, figure out the schemes within equity asset class also.
So, taking from that, and this is basically an understanding of the risk of your capital, right? Because you're talking about very high risk, you're talking about high risk. How does one differentiate between the two? Because clearly you're talking about mid cap, and does the duration also come into play then? Your ability to take that very high risk would change if you are staying invested for a longer period of time, Kiran?
See, Alex, this is only a product related thing. So your duration, what you're speaking about, is more of a personal, aspect. So we have to take that into your personal individual risk traits. So you cannot really mix up the two. So when you are actually looking at your investments, yes, if you have a higher duration, then your capacity to take that risk is high. So then you can choose the high or the very high RiskOMeter schemes. But that does not reflect in the RiskOMeter itself. The RiskOMeter is just talking to you about the particular scheme that you're looking at.
Understood. I want to talk a little bit more about the debt schemes because I think not enough attention, Kiran, is given to these. And while people choose to go in for these, particularly on the shorter end of the spectrum, going back to the Franklin incident, I think this is a natural emergence of the RiskOMeter. The incident itself caused the regulator to step up and take notice because ordinarily you had the liquid funds that were not really associated with high levels of risk, but there was actually a risk that was creeping into the portfolio. So what are the most obvious errors that people make when they're approaching debt funds, and in that context, how important is it for them to understand the RiskOMeter score when it comes to debt funds?
Right. So, see, the typical mistake that is made even within debt funds is that just knowing that as a category, debt is less volatile than equity, it is taken to be understood that debt is less risky than equities, whereas that might not be the case. While, equities, what happens is if the market is down or, your particular scheme is not doing not doing well for some time, you can wait and you can wait for that scheme to do well again when the underlying scripts are doing well. Whereas in debt, if there are papers within the scheme which don't pay, so basically what does a debt scheme hold? They are holding investments in debt instruments. So that debt instrument is supposed to pay a certain interest, which is called a coupon at certain defined times. And it is supposed to pay the money back at a certain maturity date. Now, the credit risk is that the money does not come back to the scheme on the maturity date. So that aspect is covered by the RiskOMeter. The second aspect which is covered is the liquidity risk. So basically, if there are no buyers in the market, like what happened in the Franklin incident that you were talking about, so there was a liquidity issue in the market. So the scripts couldn't be sold when there was a pressure on withdrawal out of the schemes. So that also is to a certain extent covered in the RiskOMeter. The third portion, the interest rate risk, obviously it is built into the RiskOMeter, but most people don't understand the interest rate risks. So interest rate cycles, impact the returns on the debt scheme. So that is something which is not very obvious and people don't understand that. So looking at the RiskOMeter, I think could be a very good beginning to judge even within the debt schemes whether that is suitable to your particular requirement. It's not just that because a particular scheme has been doing well for some time, it will also keep doing well in the future, or it will suit your specific requirements for your funds that you wish to invest.
I've asked guests in the past, Kiran, to explain interest rate risk, and I'm going to take a chance and ask you again today, because this is something that it took me a while, I must admit, to understand how interest rate risk pans out. Would you like to take a swing at it to get my viewers to understand interest rate risk?
Yeah, sure. Let me not define it. What I'll do is give an example. So a simple thing that you buy a debt instrument from the market at 100 rupees, and it is giving you a rate of return of 7%. So the coupon rate is 7%. So what happens in an interest rate change scenario, the interest rate can either move up or down. Now, suppose the interest rate is to move up tomorrow. So there is a new paper in the market, which is again at 100 rupees, but the interest, the coupon on that is 8%. So what does that mean? That any investor who wants to put money and buy this particular instrument would prefer the paper which is giving 8% return, right? Not the 7% one. So in this scenario, the paper that you're holding with a 7% coupon will fall in value. Now, on the other side, if the new debt instrument was to come at 6%, so your paper would become more valuable. So your paper would sell at a premium. So instead of 100 rupees, you would probably get 104 rupees if you sell it in the secondary market. So that is the way the interest rate risk impacts. So these are the papers which are basically built into, that is what a mutual fund debt scheme is consisting of. So it's papers of different maturities and different coupon rates. So each time the interest rate cycle changes, it moves in a different direction, the NAV of the scheme is impacted. And that's how you make losses or gains within a debt scheme. I hope this gives some clarity, because it's a very difficult concept to understand, but a simplistic way is just looking at the coupons and which direction they are moving in.
Absolutely, and you've described it incredibly well. I'm sure that people will understand it if and when the Reserve Bank of India's Monetary Policy Committee decides to start increasing interest rates. That's when you start looking at your debt portfolios a little more closely. But thank you so much, Kiran, for explaining that and indeed talking to us about risk. It's been a very insightful session today. Once again, thank you so much for taking the time.
Thank you, Alex.